Today we have an amazing episode, a must-watch episode where we go deep into yield farming. We explain what yield farming is, how to do it, and we bring on none other than DeFi Dad. Now, I've shouted out DeFi Dad on a previous episode, and he's been making some amazing tutorials showing you how you can actually use these DeFi ecosystems to create yields, to mine governance tokens, to actually leverage your position up and maximize those yields. There's a lot to unpack, and so I'm so excited to introduce today's guest, DeFi Dad. If you guys are excited to learn about yield farming, essentially the products that are driving this DeFi madness, this DeFi rush, these are the mechanisms that's creating so much excitement, and understanding them is part of the journey, understanding how to benefit from this entire trend. This video is going to be packed with new information, and if you guys are excited for that, do me a favor and smash that like button, obliterate it, destroy it. We need to make sure that the maximum amount of people understand what DeFi actually does, and I believe this video is going to be a phenomenal step in that direction if you want to learn more about DeFi. So hit that like button and let's dive in. All right, welcome to the channel, DeFi Dad. I've been really excited to make this episode, and yeah, how you doing, DeFi Dad?
Good. Yeah, thanks for having me, man. It's great to meet you finally, and I've admired the videos you make as well. So good to meet someone else educating folks in the space, and yeah, it's exciting. You know, everything is exploding. I'd say in the DeFi space right now. So excited to talk more about that.
Yeah, and as we talked about a little bit before we started the stream, everybody's hearing about DeFi, they're hearing about the DeFi tokens, but there's a lot, to me, there's a lack of understanding as to what these DeFi projects actually do and how to sort of take advantage of the products that they offer. And so you've done some amazing tutorials, and I thank you for coming on and educating the audience here about, how does one actually use these DeFi products? So do you want to start with a little background about how you got into DeFi? Like, how did you first get into this trend, and how has your, journey evolved?
Yeah. So I've been in the crypto space for just about 3 years. So I'm relatively new. I'm not someone who's sitting on a pile of Bitcoin when it was at $100. And so I got into the space just because I really just was interested in the intersection of finance and this idea that you could enable folks with a censorship-resistant form of money that no one really controls. And so, in other words, I fell down the rabbit hole of Bitcoin first. And then shortly after, because this is 2017, Ethereum was rising in price, and it definitely caught my attention. I think it got everyone's attention. And I was working in software. So I had worked a pretty standard Silicon Valley type job, mostly working in roles that would be classified under like sales, marketing, and solutions engineering. And so my job was to basically piece together really complex software and try to dumb it down and explain to folks how it would work in their business. So when I saw Ethereum, I'm like, wow, like this has a lot of moving parts to it. It's in its early stages. There's this idea that it'll be a world computer that you build applications on. But I was mostly excited for how are these applications going to stack on top of one another. And so fast forward into 2018, obviously the markets are starting to fall apart. I actually had more affirmation than ever before that I wanted to be in this space, because even as markets fell, I was learning more and more about all the projects that were being built in the space. And so I started working in marketing for crypto-related companies. And then I eventually started working on the Ethereal Summit, which is kind of like a TEDx event for the Ethereum space. And so about a year ago, it was really last summer, I thought we were years away from this, but I started playing around with Compound. I started playing around with token sets. And I realized very quickly that despite the fact that I had experience buying and selling crypto and doing the usual thing, trading, getting on a centralized exchange and seeing, can I buy low and sell high, no matter how sophisticated that would get with maybe leverage. And I started to realize, hey, there are ways to let my money earn money. And so with Compound, it just started to click that I can earn interest on stable coins that I had, or even Ether. Ether's rate was much lower, but still stable coins at the time were, as at one point it went up to 20%. And so meanwhile, you're looking out at the grander, legacy finance market and banking, and you're saying, good God, like if Chase ever paid me 20% on my dollars in my savings account, I mean, I would be flipping for joy. So I think the key takeaway here is I recognize that while this isn't the traditional crypto market focus on, is this thing going to go 10x or 100x, which is where everybody wants their money to be. I'm like, hey, I'm happy if I can see money go up potentially 20%, because we're coming off of a bear market where everything is falling. So anyways, that's kind of how I fell into the space.
Well, I think that's a really good observation, right? Which is essentially you're comparing this to traditional financial products, and that's what's going on the inside of DeFi. On the outside DeFi looking in, people are seeing the protocol tokens exploding. The reason why they're growing in value is because these internal products are offering advantageous yields when compared to traditional finance products. And so I think that's the kind of that's the essential journey I want to take the audience on today is how, what are these yields? Are they too good to be true in some cases? Are they sustainable? And if they are sustainable, well, doesn't that bode well for the underlying protocol tokens, which are kind of designed to grow in value as the usage of these internal DeFi products grow in their own utility and their own usage? And so what do you think is the number one product that someone would want to get their hands on and start to understand if they want to start going into this world of DeFi?
Download the Argent wallet, ARGENT. And the best part about it is it's DeFi with training wheels. You download it. It's a smart contract wallet with the apps built into the wallet. So I don't have to go outside of Argent and connect my wallet to an application, which is somewhat foreign for some folks who have never tried sending Bitcoin or sending Ether. You just use the wallet, and they've got lending. They've got trading strategies like token sets. They have Aave on there, which is another lending platform like Compound. But we also too should, I need to stop giving you such long answers.
No. So I'll interrupt you here. So I think that's great, right? Compound.finance, that's a phenomenal place. Argent Wallet, MetaMask. I think that a lot of the audience will be familiar with a basic wallet, with MetaMask, they're able to navigate here. But what they've been hearing about is that essentially people are creating kind of complex operations here where they're starting to borrow on one side, lend on another side, mine governance tokens in the process. And this is what sort of created the explosion over the last few months. I think that really took off to new heights with the introduction of the Compound governance token. And if you'd be interested in sharing your screen and showing some of the resources that you use and some of the thought processes you use and some of the strategies that are available. I know that you have some phenomenal videos on your channel I've seen where you walk through those. I'd love for you to share those with the audience, because I think that would really help them understand how they can, size up whether using any of these products actually makes sense to them.
Oh, there we go. So I think the opportunity that really has gotten everybody excited and interested in DeFi and what is yield farming has been this Compound governance token. So if DeFi is about being able to use peer-to-peer money applications, and in most cases allow your money to earn more for you through the form of like lending interest, market making, and sometimes what we call pooled rewards that are set aside to reward those that are participating in the market. That got a lot of attention. The thing that really has caught fire is what happens when you participate through a single program and you earn multiple forms of yield. Yeah, so in other words, I'm earning interest, I'm earning market making fees, I'm earning pooled rewards. In some cases, there's opportunities where you're earning 6 different tokens just for participating. Suddenly that adds up, and now my ROI goes from being 10%, which is great, but now it's amped up to something like 40%. So with the Compound token, every day they are distributing 2,880 comp tokens. This is a token that is valuable because it is used to vote on proposals to the Compound protocol. So all this means at the end of the day is it's very important that these decentralized finance protocols have a decentralized audience that can voice, this is where we want the protocol to go. These are upgrades we want it to make. These are, this is the way we want to design certain incentives, which affects how people make money. So what you're looking at.
So just to break that down really quick, effectively beyond the actual value of the token, the point is this governance is actually very meaningful, right? Because the choices that you'll be making with the governance token affect how the money moves and how the fees are collected and different sort of ways to secure the network. And so unlike other ecosystems where you're like, yeah, I care about, block times and stuff on EOS or whatever, but it doesn't really change my usage of the platform so much, this actually has some pretty significant impacts on the actual platform. So the governance is, for those who use these products, something you definitely want to be involved in.
Here's the core utility that we talked about with Compound. When you're looking at Compound, there are 9 different markets, 9 different ERC20 tokens, 9 different digital assets. And so we've got things like Ether, Tether, and so on. But with DAI, in this really simple example, I've lent 1 DAI. And that means that folks on the other side of the market can pay, actually, if we see if it shows DAI here. Okay, simpler example here is Ether. Right now, I can lend Ether and earn 0.27%. Really small, not super appealing. But on the other side of the equation, folks are borrowing at 3.03%. So there's that spread in between to be able to pay me as a lender. Anyways.
So wait, so why is this, for those who are uninitiated, why would the borrowing have a 3% yield and, or the lending have a 3% yield? Sorry, rephrase. Why would I owe 3%, but I'm not going to get 3% on the other side of the market?
Yeah, good question. So this starts to go a little bit more into math that is beyond me, but to keep it simple, it has everything to do with, if I have a pool of, let's say, $100 million in Ether, what is driving the cost up to borrow is the more utilized the pool is. So if the pool is, in this case, it's not showing it here. If the pool is 50% utilized, as it continues to see more and more Ether borrowed, what they're doing is they're increasing the lending interest because they want to incentivize us as lenders to lend more Ether so that they can keep up with the demand. And then vice versa. If no one is borrowing, then the rates go down. And so that's why you see 3% on one side is there for borrowing, but on the other side, in this case, I'm earning 0.27%.
So borrowing is way more exciting, or there's way less people borrowing Ether than there are lending it in this particular instance, because we have almost a flat yield on lending it. Apparently everyone's open to lending their Ether, but we have fewer people saying, hey, I want to borrow and sign up for this. And I think that is a pretty interesting conundrum, because you're like, hey, these things fluctuate more than this in an hour sometimes. How can I enter into a trade or enter into a somewhat long-term position of any sort with such volatile assets? And I think that's where you get the stablecoin phenomenon, right? Where a lot of this is happening on stablecoins. Like it seems like the most of the actions on Tether, DAI, USDC. Is that right?
So on Ethereum, there's almost 8 billion now in stable coins, or I guess we'll see here in just a moment how much there is. Obviously, this is powerful because when you have a stable coin, if you remember back in the day, we would do things like send Litecoin from Coinbase or whatever exchange to get to another exchange, because the price was a little less volatile during the crazier 2017 days.
It's also faster.
Exactly. So now we're privileged to have a digital dollar, and those digital dollars, that can still be used to, buy other crypto assets. But the goal here, the goal in DeFi is to enable you to abstract away or completely quit on centralized finance. So I haven't traded on a centralized exchange in about a year. I only use decentralized exchanges because the liquidity is there and because I'm always in control of my assets. I never have to worry about trusting those third parties. And I also, too, don't have any sort of restrictions. If I go on an exchange, they might only have so many crypto assets, but when I go on an Ethereum-powered decentralized exchange, it's just me and the code, and whoever out there is willing to supply those crypto assets.
So walk us through, and that's great for you for living in that decentralized world. Like I say on this channel a lot, that's really the future, because in the end, although there are still issues with DeFi that we'll continue to see worked out over probably years to come, the reality is that, as we saw with the Twitter hack, centralization has central points of failure. The banks have been known to abuse your money, and over time, that trend we see potentially getting more extreme, right? Where we are currently in a moment where people wonder what's going to happen with this stimulus in the banks, and are there risks of some kind of collapses of bad debt and things like we've seen in the past? And that just those particular instances are not something that can happen here in the code if the code's performing right.
That's right. And at the end of the day, I think for all the virtue signaling that I could do about, decentralized finance, it's peer-to-peer, it's the trustless, finance system that we were promised. It's everything that it really plays into this narrative of what was once digital cash, but going so many steps further. At the end of the day, it's money that drives folks to our space. There are humongous opportunities in DeFi in terms of what you can earn. So like, for example, if we go back to this compounding example, so if I am a lender or a borrower in the market, I can earn this comp token, COMP, which is a governance token, which gets traded on decentralized exchanges. It was trading there before it ever went to Coinbase. We don't have to wait in the DeFi world for someone to list it. It can be someone like myself. I could have one token and I can go to the DEX and I can just list it. Like, all I have to do is be willing to provide the liquidity. So anyways, they start issuing this. Currently, the amount of comp being paid per day to the 9 different markets, 50% goes to suppliers or lenders, 50% goes to borrowers. Now, the amount of comp being paid per market is based on borrowing demand. It used to be based on interest rates, and that was something that folks quickly discovered you can game. And we saw the BAT token market go up to hundreds of millions of dollars, which was kind of ridiculous because it's just, I have no thesis on the BAT token itself, I guess, but it was radical to see all of these markets shrink and for all of the money to shift to the BAT token. And so what we're seeing now is all of the borrowing demand in Compound is actually focused on this DAI market. So about 2,300 comp per day is being distributed. That's split 50-50. So that's, what is that? 1,150 comp, 1,150 comp to borrowers. So lenders versus borrowers. All right. So if I go to Instadapp, and Instadapp is essentially, it's like a DeFi super tool. It's like a dashboard that allows me I can lend to Compound, but it gives me DeFi superpowers to use things like flash loans. And in this case, the point is this: I don't have the ability to build a leverage position in the same manner on Compound as what I can do on Instadapp. So one of the video that the DeFi tutorial that I made that really got the most views so far is the fact that, so check this out. What I did first is I lent 100 DAI. And then I came here to the maximize comp option. Sorry, I just got the video over it. And what I did is I created a leverage position with stablecoins. So I can borrow 75 DAI for every 100 DAI that I lend. And so in this case, let's just pretend I've obviously already done this, but what I ended up doing then, here we go. I started out with 100 DAI. I borrowed up to 200 tether against it. Then in one transaction, this is all happening. I wouldn't be able to do this if it weren't for like Instadapp. In a single transaction, the tether that I borrowed gets swapped for DAI, and it gets redeposited. So now I have 300 DAI lent and I have 200 tether borrowed. And all this means is that I went from having 100 DAI earning me the comp token to now I have 300 DAI plus 200 tether of earning power. So basically my earning power has gone up 5x. And meanwhile, I'm using stable coins. These aren't volatile assets. I'm not worried about the price of Ether or one of these other tokens dropping. I'm borrowing 1-to-1 against one another. And so it's powerful to be able to say, I'm going to create what they're classifying as a risky position. But in my book, it's less risky for me personally with my money because I know that these are dollar pegged. One of these would have to completely fail as a dollar pegged stable coin in order for this ratio to blow up to 75% and get me liquidated.
Well, so I appreciate you sharing that, right? And that's really the powerful thing that I think people are trying to understand is, how do I put my money to work? And what you've essentially said is, without these mining mechanisms for the governance tokens, there's not really an incentive to borrow and lend and lend and borrow and borrow and lend and lend and borrow. It just doesn't quite makes sense. However, because now Compound showed that by adding this incentive of the governance token, you can now add a new dimension to the DeFi ecosystem, which, as you've explained now, allows for you to essentially create these leveraged positions where you're mining this token, you're creating a ton of sort of interactions, and in some senses, you're actually inflating the real value of the assets in the ecosystem, because you're creating a sort of, you've now, as far as the smart contract is concerned, you've now contributed $500 worth of assets, but you really only started with 100. And so not only is it powerful in that it can create opportunity, but it also creates some extra risk. And I think this adds kind of like nitrous oxide to the DeFi explosion, because on paper, the assets in the ecosystem are ballooning, right?
So one thing to point out here is just to like walk through what I just did there. I supplied 100 DAI into a pool. I borrowed from a tether pool, which someone else has supplied that money to. And by borrowing it, I am paying 7.36% to them. So all of this at the end of the day, notice I'm still working in an over collateralized world. So I borrowed, I added. The math here that kind of throws people off is they're like, it looks like you have 5x the earning power. You're right, because the compound market recognizes lenders and borrowers separately, and they're wanting to distribute the governance token to lenders and borrowers so that they have a voice in governance. And so this is me still playing within the confines of their math, but I have really just taken advantage of the fact that stable coins are stable. They're not volatile. It puts me at a reduced risk of being liquidated, and I've ultimately maximized it. That's why it says maximize comp mining, so that I'm lending 300 DAI and borrowing 200 tether. This is the most complex that gets, though.
And this particular example, right? This can continue so long as the DeFi, as the comp mining continues, right? So that's what's really the factor that's propelling this, is the fact that there's an added incentive for doing these. Otherwise, over collateralized lending and borrowing in and of itself, I don't see as necessarily a hit product that's going to be bringing new audiences. However, the ability to sort of lend, borrow, and yield farm is the real exciting trend, right? And now you're seeing introductions of similar governance tokens with Kyber Network. You're seeing introductions of governance tokens across the board, because this model is going to to get essentially copied by almost all of these lending and borrowing ecosystems. This is not going to be unique to Compound, right? And then each one, as soon as they introduce these governance tokens, is going to create a race to get these, because as all of these mining schedules, because we're all children of Bitcoin, we know that the mining schedules slow down over time. And so it's sort of like, this is the magical moment of DeFi, right? To yield farm. This isn't going to go on forever, right?
Yeah. I think we are going to see wars between different DeFi platforms like a Compound competing for people to lend and borrow on to, in this case, let's say, earn a governance token. But one thing that's pretty understated here is Compound worked very hard over the last few years to create one of the most secure DeFi platforms, and with the audits to prove it and the track record to prove it. So like, make no mistake, part of the reason this comp token has been so sought after, part of the reason this comp mining has sort of gotten so exciting is it's a reflection of people trusting in that Compound team. There are many other platforms out there that will not be able to replicate the sort of like frenzy of capital that's coming into this market.
Yeah, and I think, like, if you look at the top holders of the Compound token, you see some names like A16Z, kind of like Silicon Valley titans, right? And you wonder, how did Compound, just like this, explode onto the market with their governance token, and the next day they're on Coinbase? This is a very big project, right? This is a very legit project. This isn't a garage band project of a couple of blockchain lovers that got together and put their heads together. There's some big money behind this, right?
That's right.
And I think that's, for the big projects in DeFi, I think you'll see that, right? Because having the liquidity locked up is part of what makes the whole thing tick. You can't do this without big amounts of liquidity locked in, and Compound is clearly leading the game right now. Maker was the king, and now Compound has come in with their token and kind of created a new model. But like you said, there's going to be wars here, and there's going to be moments where other DeFi platforms get hot, and people see, hey, I need to move my assets from Compound to this other one to maximize my yields. And that's kind of the game, right? Is people are going and they're trying to find the right balance of interest rates, borrowing rates, and yields. Are those the three aspects of the equation, or are there even more aspects? Like, I guess volatility would be the fourth, right?
I think one point that you've made here that stands out for me is the fact that there's no cost to moving my money from platform to platform. So at the end of the day, people really are working off of what is the incentive. Like, it's very that idea that it costs you money even when you're not earning. Like, if you leave cash in the bank, that's costing you something. It's much more evident in the DeFi world, because you know that your money can be earning you, in this case with mStable, 21% as of today, and this has been up as high as 32%, and these are stable coins. So yeah,
so walk us through this, because this is the highest yield I've seen on a stable coin, right?
Yeah.
And is, walk us through mStable here, and why wouldn't someone just sit in this one, obviously? And can you access this through the yield farming on Compound? Can you involve this in your equation?
Yeah. This is one of the applications out there that I've been most excited about for anyone who's new to the space. I kind of regret showing the comp Instadapp like mining mechanism. It's very popular because at the end of the day, if we look at the price of comp and let's say it's $300, well, I am now earning, I'm earning 73.77% APY. That's my daily APY. So as the price of this token goes up or down, in this case, I'm earning 36%. It's still really high, but I'm very dependent on a volatile token that is new to the market, and God knows where it's going to go up or down.
Correct. It's still in price discovery mode. And if you go back to that spreadsheet for just 1 second, you can see that without that factor in there, the price of comp fluctuating, and we've seen this thing drop 50% in a day. The fact that this asset's so volatile, it can rapidly put your entire equation into an unprofitable situation, or potentially something where it doesn't make sense, right? Because you're now mining something that doesn't have value.
This is another reason why DeFi is so popular. What you just said is it's not true that you could then be unprofitable in most scenarios. It's a matter of how profitable am I from zero. So the cost here for me to get involved in that whole comp mining exercise, whether I put in $1,000, whether I put in $1, whether I put in $1 million, I'm probably paying $15 in fees because of the flash loans that I use on Instadapp. So notice if I put in, these are obviously big numbers I'm not working with, but if I put in 100,000, I'm still earning the same daily APY of 36 or 37%, but I'm earning about $3,000 every 30 days. However, when this goes up to 300 now of course it's doubling that. It's $6,000.
And what if it goes down to $10, right?
And if it goes down to $10, well, now I'm earning, let's go back to $1,000. Let's pretend I start with 1,000, amplify to 3,000 lending and 2,000 borrowing. I'm earning still $2, but I spent $15 on flash loans. And so I netted a loss of $13.
So there is
nice.
Potentially ways, given fee structures, which I believe will be resolved, right? In the future, fees will be less with ETH 2.0. We dream of you, ETH 2.0. Please text back. But and there are ways where this can become a loss, a small loss, right? Not a big loss, right? Because your loss is coming from fees here.
This is my maximum loss here that I'd be worried about is the $15 I spent there, because at the end of the day, I am being paid lending interest for the, let's say in this case, I start with 1,000, I'm lending 3,000 and earning interest. I'm also paying some borrowing interest there daily. And I'm actually netting out, in this case, I'm netting out 7 cents per day on this really simple example. So it is the ability to let money.
So you quit your day job as soon as you got that 7 cents a day, obviously.
Yeah. I know. The numbers are, notice too, the thing to call out.
So there's still risk, right? I think that's the thing, is there's still risk, existential risk, right? We've seen hacks, we've seen bugs, we've seen exploits. And so if the yield is going to be as low as $2 on $1,000, is that worth it without the governance tokens? Is that really worth it, right? Is that worth the risk? And I think that's really a factor that I think will, over the course of DeFi's history, as it grows, things will become more secure, and that risk will diminish. The chance of a bug, the chance of an exploit will go down over time. But I think currently, the last big DeFi hack exploit was only weeks ago, right? We heard about something in Balancer, I believe. And so stuff can happen. Poo-poo happens, right?
But even that, so I think if for whoever watches this later, the key takeaway from this is you need to be conscious of the risks, like a smart contract bug that could lead to an application losing all of its funds. That's obviously the doomsday scenario, but it has happened, it has. So you need to be conscious of that. You want to know whether they've been audited or not. And then there's other things to concern yourself with, like, could there be a black swan event where a stable coin fails? That would be disastrous for any of us holding it. At the same time, though, when I think what you and I proved here is, if someone looks at this and says, what happens if comp is, let's say, $10 today? This is not worth my time. I'm putting in $1,000 and I'm earning next to nothing. It's 2.46%. But when people saw that the comp token was up at $300, well, now they were earning 73%. And that's why there was such a frenzy, because you're earning the reward that you're earning. If someone said to you, I'm going to give you 0.05 Bitcoin every day, obviously, like, to us, that's a lot of money because of the value of it. But if someone else said, yeah, but Bitcoin's volatile, man, it could go down, you're like, who gives a shit? It's a reward. It's icing on the cake here, So that's the part of the narrative with DeFi that many people miss is in one way, we've all been trained to question, is this thing able to be a long-lasting mechanism for an alternative peer-to-peer finance system? Great, you're right. But I'm telling you that the economics here, in most cases, play out so much better than me trying to buy low and sell high. Most are terrible at trading, So unless you're going to dollar cost average into Bitcoin and ETH and other tokens, and even that,
even if you are, right? And even if you are, there's no reason why you can't put those hodls into to being productive for you.
That's right. Yeah, if you were DCAing all of 2018, felt pretty shitty. Right now, though, you feel amazing, and that's part of it. Is it's kind of like I don't throw every dollar into DeFi. At the end of the day, my portfolio is mostly me just being long on premier tokens like ETH, like Bitcoin. For me, I think SNX is another one of them. But beyond that, this is where I say, hey, I got 10%, let's say, in stable coins, which is I think a pretty healthy ratio to sit in. 10-20%. This is where I want my money to be earning money. I want that 10 to 20% to work for me, not to sit in stable coins waiting for me to just buy the dip. I can rip it out whenever I want from this DeFi app and then go buy the dip if there's some sort of a crash in the market.
Yeah, well, I love that. And, part of my questions here are intended to be probative, intended to sort of be a little devil's advocate and ask you about the negative sides.
Oh, you're asking the right ones, man. No, these are I want people to be cautious. I don't want someone to watch this video and to say, I'm going to go throw my life savings into mStable and I'm going to earn 21%. The fact, that's part of the reason I wanted to talk with you too, is I love the fact you call out the risks. It's very, very important that folks are conscious of it, and then how to mitigate it, and making sure that if you participate in DeFi, I try to think about whatever money I put into a single app, if that app were to fail, would I be able to continue with my life and be happy? And if the answer is I would be devastated and it would ruin my life, then I clearly am putting too much money into that DeFi opportunity.
Yeah, for sure. And I appreciate you echoing those concerns. And it is exciting, right? And to return, what makes this moment exciting is that beyond the fact that, like you said, this plays out so much better than particularly just hoping for the number to go up, right?
Right.
Even if you're dollar cost averaging, right? With the understanding that there are existential risks, right? The bank, even in the normal banking system, there's existential risks, as we're seeing, right? So there's existential risks all over. But now that we've put that aside and we understand there's existential risks, the actual basic economics of this actually play out fairly. They make sense, right? And when you start adding in these governance tokens, that's where you get this explosion. That's where you get this excitement. And a product like Instadapp .io, that is something where the audience now understanding the risk can say, okay, well, if I want to start getting a little fancy here, take my $100 and really try to fold it over and make it really try to powerfully get as much of this governance token as I can. And I believe that this is just, as we said, the beginning of the governance tokens really starting to flood the market and people becoming just voraciously searching to how to mine these because that's the little gold rush, right? That's the DeFi gold rush. And as people are inflating the amount of assets here in these ecosystems trying to mine those governance tokens, you get, in a lot of cases, a very significantly inflated value of those governance tokens. And so this, which of course, as you said, just to bring it full circle, is great marketing for the industry, right? And that's what makes everybody wake up and say, hey, let's learn about DeFi. Like, it's not an inherently sexy thing, but you add in these extra mechanisms, and that's when you're seeing the magic happen around why DeFi is the hottest trend in crypto, is because it's the first trend in a very long time that's been a sort of winning game. And people are winning big on it. And I think this has been a great walkthrough of how to get your sort of feet wet. And recapping obviously the basics, we have Argent Wallet, right? We have compound finance. That's like the tip of the iceberg. Then you go to the next level and you have Instadapp, right? And Instadapp becomes where you start yield farming. If you were to say to people, is the easiest thing to do, just focus on Instadapp and maximizing your comp your comp mining, is that probably the easiest, most basic function that people would want to go and participate in, or is there yet another layer to this that you would say, hey, if you really want to learn, go try this?
The two windows that I had pulled up here is because we started so like that Instadapp opportunity that's about as sophisticated as anything gets.
Mm-hmm.
I think the nice like starter point or something that provides a very large at this point a very large return in this 22% APY, it's stable coins, because mStable is the ability to be able to swap between these stable coins like True USD, USDC, DAI, and Tether. And
how did they provide 22% returns? How does that work?
Yeah, the way that they do it is that every time, if I were to go in here and say, hey, I want to swap USDC and True USD, these are normally close to 1-to-1. And the goal of this app is to enable stablecoins to be closer to 1-to-1. If I were to be trading between these, they're taking 0.1%. So at the end of the day, this is the utility that drives the flywheel that it is. But they also have, so another part of the equation is, we talked about what happens if one of these stable coins fails one day. Well, they have what's called MUSD. It's just a basket. It's ideally in the future, it should be split even, 25%, 25%, 25%, 25%. It is currently not, by the way. I want to caveat, this is a very like new platform, so the ratios are not anywhere near that. But think of it this way. What happens if there's this black swan event and Tether somehow collapses? You and I are holding MUSD. We're hedged against that. At least we're holding a basket now that's now 33% of the other, different tokens there.
So MUSD is a swap service, right? But there's a lot of swap services. So say MUSD's popularity wanes. Does that mean that the APY you're earning also wanes with it, because their fees, they're not collecting as many fees, so they can't provide the same returns? Is it that simple, right? This fee structure is a representation of its popularity as a platform, right?
Absolutely. This fee is a representation of when you deposit your tokens here also. They are, I believe the way it works is they're depositing all of those or some of those into compound interest earning tokens. So they're taking compound and they're adding this swap fee that we're paying. And that's how we're getting this higher yield out of this. And then on top of it in the future, they have other mechanisms at play here. Like there will be the ability there is the ability already to earn their own governance token. And once that is generated on the market and has an established USD value because of buyers and sellers on the DEXs trading, that's a whole nother part of it that they could potentially take profits on. So a lot of these mechanisms, they look too good to be true, but it's because they're stacking different mechanisms on top of it. It's like Dan Elitzer at IDEO Collab calls it like aquaponic yield farming. You're making the most of all of these mechanisms, and the return is, you look at it and you go, holy shit, 21, 22%. Like that's high, despite the risk that you're.
Of course, the cynical approach would just say that stack looks like a house of cards, right? Because if any one element fails, it ripples through. And that's where I think that it's important to understand that, as exciting as this moment is, there is that really, if any one of these pieces, they're not isolated anymore. These mechanisms are all being commingled and stacked in such a way that it'll start taking out, like one failure could ripple. And so that's where I think the added risk comes from with DeFi. But at the same time, it's super exciting. Like, when have we ever been able to, like a video game, stack financial transactions trustlessly? It's a brave new world. And I think that that's what's so awesome about it. And I thank you so much for sharing and educating the audience on this. Because I think at this point, there's so much to take in that we just have to, this has just been so much. This has been so much. I don't want to overwhelm the audience. Their heads might explode right now. Go ahead.
I think the key takeaway is, don't wait to try these apps. You can play with as little as $1. That's how I got started. I approached it very cautiously. I had concerns really about smart contract bugs. We called out liquidity risks. We called out governance compromise. admin keys is something we didn't talk about, but just remember, most new DeFi apps they're launching, and they're not a perfectly decentralized flywheel yet.
Mhm.
They are being pragmatic, and they have a key to shut off the app if suddenly some disastrous bug is discovered, which is a risk. What if that founder is held hostage, and held with a gun to their head and told do XYZ with the app? So anyways, yeah, long story short is, try sooner, but take it easy as you check these out. And I think the ones we called out were what? Argent. I love the Dharma wallet. It's very simple for simply investing digital. You can put dollars like fiat directly into CDAI, which is earning you interest with DAI. And then the other one was Compound, which is actually in the Argent wallet, unless you have MetaMask. Go and try it on your laptop at app.compound.finance. And mStable. mStable.org is the other one. That one it's new. I accept that whatever money I put into it, there could be some unforeseen disastrous bug. They have audits, but I think it's exciting to try it. And by the way, I have no partnerships with any of these folks. I've not taken money from any of them. So like right now, I'm talking about my own journey with my own money. I think folks should be very careful because I am not a financial advisor, but I am a DeFi geek. I love this stuff. It's fun to make your money make money.
Yeah, and I truly appreciate that. I think the audience truly appreciates that. So thank you so much for coming on the channel, sharing your expertise. I would love to catch up with you in a couple of weeks or months and see how this whole movement's progressing. You guys, do me a favor, for all this knowledge, for all this wisdom imparted upon you, click the link in the description and go show some love to DeFi Dad's channel. Give him a subscribe. He's got great knowledge that people need to understand. This knowledge needs to be shared because just in buying, just looking at CoinMarketCap and buying the next DeFi altcoin, you're not really understanding the movements or the mechanisms that's driving this market. By understanding those mechanisms, you can become a better investor, you can become more successful, and you can actually understand potentially where the next best opportunities come from by understanding how the machine works. So thank you so much for coming on the channel. And if you have any final words for the audience before we sign off.
I just made this simpler. Like my YouTube channel had one of those crazy random URLs. It's just DeFi Dad, DeFiDad.com. Go to that, it'll redirect you. And hey, you're one of the few people I've really noticed is actually championing and exploring this. So I'm very grateful that that you're actually trying to educate your audience on this. So looking forward to having more conversations on this in the future.
Thanks so much, man. We'd love to have you back soon.
Thanks.
Well, that's it. I hope you guys enjoyed the video. I certainly did. If you guys enjoyed it, if you got any value out of it, if it helped you understand this DeFi movement, this DeFi trend, do us both a favor and smash that like button. Don't forget to go over and give some love to DeFi Dad's channel. The link's in the description. And of course, if you're not already subscribed to FUD TV, we're doing daily videos now covering new altcoin gems, covering DeFi mechanisms, covering altcoins across the space, and just developments in the cryptocurrency industry. It's information I think will benefit you. And so I highly encourage you to hit that sub button and don't forget to click that little bell notification. As usual, my name's Elio Trades, and I'll see you very soon on the next episode.